Welcome to the Nifty Noon podcast. Imagine hackers spending 6 months playing just this massive global long con.
Yeah, it's wild.
Right, like we're talking flying across the world to shake hands, literally depositing $1 million of their own money just to build trust. And all of this to pull off a $285 million heist.
Without writing a single line of malicious code.
Exactly, not one line. So today we're doing a deep dive into the daily crypto updates from the past week, pulling directly from our newsletter, Nifty Noon. And, if you are sitting there trying to make sense of a market that feels completely schizophrenic right now, you are in the exact right place.
You really are. Because, it has been a wildly volatile stretch. The sheer volume of technical updates and, regulatory actions, it can definitely induce information overload.
Oh, totally. It's like a fire hose.
Right. But when you step back and look at the underlying mechanics, the seemingly random events of this week actually form a very coherent picture.
They really do. And to give you the TLDR right up front, we are watching two massive dominant themes kind of just collide. So theme one, traditional finance, or, TradFi, is no longer just buying digital assets to speculate.
Yeah, the speculation phase is kind of over.
Right. They're physically ripping out their legacy backend systems and replacing them with blockchain rails. And then theme two, decentralized platforms like DeFi and prediction markets, they're frantically upgrading their infrastructure to handle all this Wall Street capital.
While simultaneously fighting a two-front war, I should add.
Yes,
yeah,
exactly. Against, state regulators on one side and then highly sophisticated state-sponsored hackers on the other.
It's a classic infrastructure maturation phase. We are stress testing the bridges at the exact same moment we're inviting the world's heaviest traffic to cross them.
That is a great way to put it. So, to really understand how these forces are interacting, we need to trace the cause and effect of the market this past week. Like, chronologically.
Yeah, let's walk through it day by day.
Okay, let's jump into the start of the week. So, Monday, March 30th, Kalshi, the prediction market platform, got approval through Kinetic Markets LLC to offer margin trading to institutional pros.
Which is a big deal.
Huge deal. So, hedge funds can now use leverage to bet on their event contracts. But almost simultaneously, the state of Washington sued Kalshi for, quote, disguised gambling.
Right on the heels of that temporary restraining order they already faced in Nevada.
Exactly. So my question is, if you're a massive hedge fund, why are you bothering with a platform that local governments are actively trying to shut down?
Well, because the payoff for regulatory clarity in this specific asset class is astronomical. What's fascinating here is the paradox we're seeing. Kalshi is building these institution-grade financial tools.
Like the margin trading.
Right, things like margin trading, which allows a fund to take a large position without, locking up all their liquid capital, plus strict insider trading filters. They are operating under the premise that their event contracts, which let you hedge against things like election outcomes or inflation data, fall strictly under the jurisdiction of the Commodity Futures Trading Commission, the CFTC.
So they are basically saying we are a federally regulated derivatives market, period.
Precisely. That's their stance. But the states are countering with, no, you're an unlicensed online casino bypassing our local gambling laws.
It's a mess.
It is. Kalshi is fighting a brutal two-front war. They're leveling up their infrastructure to meet Wall Street's compliance standards while simultaneously battling this, final boss of state-level courts.
Right.
And if they survive, it proves prediction markets are a highly credible, legally bulletproof asset class.
Okay, so Kalshi is building legal firewalls, but then we move to Tuesday, March 31st. Over the decentralized finance sector, protocols are having to build structural firewalls.
Yeah, structural is the key word there.
So AV, one of the largest decentralized lending platforms by total value locked, or TVL, deployed its massive V4 upgrade on the Ethereum mainnet. And they introduced this new hub-and-spoke liquidity architecture.
Which is a fundamental redesign.
Okay, let's unpack this. Let me try to visualize this for you. Is it essentially like the Titanic? Like old DeFi protocols had no bulkhead, so if one collateral asset failed, the whole ship flooded and sank. But AV4 introduces watertight compartments.
That is exactly the right framework. Historically, liquidity in these lending protocols was just pooled.
Right, all in one big bucket.
Right. So if a vulnerability was found in one obscure, highly volatile token used as collateral, an attacker could theoretically drain the entire central pool.
Oof.
Yeah, devastating. But Aav's new model separates the liquidity into independent spokes. So say one spoke for Lito's staked Ethereum and maybe another entirely separate one for Athena's synthetic dollar.
Wait, if liquidity is separated into different spokes for assets like Lido or Athena, doesn't that fragment the market and make the whole system wildly capital inefficient?
Well, that is the trade-off you have to make for survival.
Really?
Yeah. I mean, yes, you introduce some fragmentation, but you completely isolate the contagion risk by letting independent spokes dictate their own specific risk parameters. Agave is basically building a containment system.
Ah, I see.
If the Lido spoke gets compromised, the blast door seal and the rest of the protocol's billions of dollars stay perfectly safe.
That makes a lot of sense.
And frankly, that blast shield is a mandatory prerequisite for Wall Street. Institutional players are not going to park $1 billion in a smart contract if a glitch in a meme coin can wipe them out.
They absolutely won't. Well, Agave might be building a blast shield against market volatility. But then on Wednesday, April 1st, Google researchers reminded everyone of a threat that could vaporize the entire foundation.
Oh, yeah. The Q-Day warning.
Yeah, they published a paper indicating that future quantum computers could crack the elliptic curve cryptography that secures Bitcoin and Ethereum using, like, 20 times less hardware than previously thought.
Which is a massive leap.
Justin Drake from the Ethereum Foundation even warned that he sees a 10% chance of Q-Day arriving by 2032.
I know that sounds like a plot point from a sci-fi thriller.
It really does.
And if you hold your own digital assets, hearing this probably sends a chill down your spine. Elliptic curve cryptography is the mathematical bedrock of nearly all modern digital security.
Right, so it keeps everything safe.
Exactly. It relies on math problems that are incredibly easy for a computer to perform in one direction, but practically impossible to reverse engineer.
Unless you have a quantum computer. I mean, the paper said in a worst-case scenario, a quantum machine could theoretically derive your private key from your exposed public key in just 9 minutes.
Yeah.
Meaning anyone could just take your funds.
Yeah.
9 minutes is terrifying.
It is terrifying if we assume the blockchain industry is going to stand completely still for the next 8 years.
Which they won't.
Right, they aren't. I mean, a machine capable of breaking this math does not actually exist today, and the broader tech sector isn't just, waiting for the meteor to hit.
Good point.
Google is already aiming to migrate its own internal systems to post-quantum cryptography by 2029.
Still, upgrading globally distributed decentralized networks like Bitcoin or Ethereum requires consensus.
Yeah.
It's not like a tech company just pushing a mandatory software update to your phone.
No, and that is the real friction point. Transitioning these networks will be a monumental engineering and political challenge. But proactively having this conversation now hardens the system.
Yeah, it forces the issue.
Exactly. Solving the quantum threat isn't just about survival. Successfully upgrading these protocols will actually serve as the ultimate proof of their resilience, which drives long-term institutional confidence.
Well, securing the cryptographic base layer naturally links to Wednesday's other big news from our newsletter, because you also need to secure the legal base layer.
Right, the Genius Act.
Yes. The U.S. Treasury officially began rolling out rules for the Genius Act, which is the first federal stablecoin law in American history.
Which is huge, and this completely mirrors the logic behind Alab's upgrade and the quantum defense preparations. Well, you cannot run the global financial system on private stablecoins if the legal definitions change every time you cross state lines.
Ah, right. It's that fragmentation problem again.
Exactly. The Genius Act rules, which are being proposed by the FDIC, are laying the groundwork for massive enterprise adoption by providing federal regulatory clarity. It basically tells banks exactly how these digital dollars need to be backed and audited.
And traditional finance didn't waste a single second once that groundwork started settling. Which brings us to Thursday, April 2nd. Franklin Templeton, this legacy Wall Street heavyweight, agreed to acquire 250 Digital, which is a crypto investment firm that's spun out of Coin Fund.
Right.
And they are launching Franklin Crypto to target sovereign wealth funds. But here's the mechanism I want to focus on, because this is crazy. They didn't just wire fiat currency to buy this company.
No, they didn't.
Franklin Templeton used its own tokenized money market fund, the BNG token, to pay for part of the acquisition.
This is a watershed moment that I think a lot of mainstream observers totally miss.
Oh, completely.
Normally, corporate mergers and acquisitions take days to settle. You are dealing with wire transfers, escrow accounts, clearinghouses like the DTCC, and just a mountain of legal friction.
Right. It's a super slow analog process.
Very slow. But by using the BNJ token, Franklin Templeton essentially handed over a programmable digital bearer asset that yields interest.
Wow.
It settled the corporate acquisition instantly on a public ledger. It proves legacy institutions aren't just selling crypto products to their retail clients anymore. They are utilizing the technology for its intended, purpose-efficient, instant settlement.
And then on Friday, April 3rd, SoFi followed right in their footsteps. They officially launched big business banking on the Solana blockchain.
Which is exactly what it sounds like.
Yeah, they mashed up a traditional nationally chartered bank with a high-speed crypto rail. But I mean, do large enterprises actually care about using Solana?
They care deeply about capital efficiency. Historically, if you are a large business operating in the digital asset space, your back office was a fragmented nightmare.
Just totally siloed.
Exactly. You had to use one provider for asset custody, a completely different traditional bank for your fiat payroll, and maybe a third-party exchange to access stablecoins. Your capital was constantly trapped in transit between these silos.
So you're basically just losing money waiting for banks to open on Monday morning.
Exactly. By uniting all of this under one regulated roof, utilizing their own SoFi USD stablecoin, and partnering with major crypto-native market makers like Cumberland and Wintermute SoFi is solving the liquidity bottleneck.
That's massive for enterprises.
It is. An enterprise can hold US dollars, swap them to digital assets, and settle globally on a Saturday night, bypassing traditional banking hours entirely.
But the ability to move millions of dollars on a Saturday night is a double-edged sword.
Yeah, it definitely is.
Because that 247 efficiency means you can also get robbed on a Sunday. And that brings us to the start of the second week, Monday, April 6th. This is exactly what happened to the Solana ecosystem. Drift Protocol, a major decentralized exchange, lost $285 million to an exploit.
Half of their TVL gone.
50% of their total value locked. To me, this is where the story gets really dark. Because here's where it gets really interesting. How does a top-tier protocol lose hundreds of millions of dollars without a single flaw in their smart contract?
Because the vulnerability wasn't in the code, it was in the people.
The people.
Yeah. This was a highly sophisticated 6-month-long social engineering con executed by North Korean state-linked hackers.
6 months. This wasn't just a quick phishing email with a bad link.
Not at all. The hackers posed as a legitimate quantitative trading firm. They literally flew out and met with Drift contributors in person.
That is insane.
They deposited over $1 million of their own capital into the protocol just to establish a track record of trust. And ultimately, they manipulated the team into downloading a malicious beta testing app via Apple's test flight program.
Which totally bypasses the normal security checks of the public app store.
Yes, exactly. And that malicious app compromised the devices of the developers, giving the hackers access to 2 out of the 5 signatures needed for the protocol's multi-sig security council.
Let's clarify that for the listener really quick. A multi-sig is essentially a digital safe that requires multiple different keys to open, usually held by different people, to prevent a single point of failure.
Correct. But here is the truly devious part.
Oh, it gets worse.
Yeah. The hackers used a legitimate feature on Solana called a durable nonce.
A durable nonce.
Okay. It basically allows you to pre-sign a transaction and broadcast it much later. So the hackers pre-signed the administrative transactions to drain the protocol, let them sit completely dormant for over a week so no security alarms were triggered, and then executed them all at once.
Wow. To me, the drift hack proves that humans are the ultimate malware. You can have a mathematically perfect smart contract, but if a developer is tricked into downloading a bad app on their phone, it's just game over.
Game over.
It really shatters the illusion of trustless DeFi if a small council of humans holds the ultimate override keys.
It absolutely does. And it sparked a massive philosophical debate because the community immediately demanded that the centralized company behind the USDC stablecoin, step in and freeze the stolen funds.
Right, yeah.
So you have a decentralized community begging a centralized corporation to act as the police force, which basically contradicts the entire ethos of the space.
It's a brutal lesson in external dependencies, and you can see the market learning from it in real time. Just a day later, Tuesday, April 7th, Polymarket announced its V2 upgrade.
Which is very timely.
Extremely. They are completely ditching Polygon's bridged USDC for their own native Polymarket USD stablecoin.
The timing is incredible, and the narrative continuity here is vital because you have to understand how bridges work. Normally, if you want to move assets between blockchains, you lock your actual asset in a smart contract on chain A, and the bridge mints a synthetic representation of it on chain B.
But if someone hacks the smart contract on chain A and steals the real asset,
The synthetic tokens on chain B instantly go to zero. Precisely. Bridges are massive honeypots for hackers because they hold billions in locked value. By creating a natively issued asset, Polymarket is heavily reducing its reliance on these vulnerable external bridges. They are securing their own settlement rails ahead of a massive planned expansion into the U.S. market.
and we know they have the wind at their back, because also on Tuesday, the Third Circuit Court of Appeals just ruled in Kalshi's favor on their ongoing regulatory battles, which gives massive legal momentum to Polymarket and the whole prediction market sector.
Right, the infrastructure is hardening across the board.
And Polymarket upgrading its infrastructure is a perfect example of crypto networks maturing, but traditional finance is having to mature right alongside it. So moving to Wednesday, April 8th, the CME Group, the Chicago Mercantile Exchange, literally the largest derivatives exchange in the world, announced they are adding AVAX and SUI futures.
Which is notable on its own.
It is. But the real kicker, by May 29th, they are shifting their entire crypto derivative suite to a 247 trading schedule.
If we connect this to the bigger picture, this is a profound philosophical shift for Wall Street. For the last decade, traditional finance has tried to force crypto to adhere to its rules.
Right, the 9 to 5 hours, closing on weekends and bank holidays.
Exactly. What CME is doing here is a total concession. They are acknowledging that global, decentralized blockchains do not sleep. TradFi is no longer trying to tame the schedule of crypto. They are adapting their legacy business models to fit the non-stop nature of digital assets.
It is the ultimate validation. But of course, no matter how institutionalized this space gets, it still loves its ghost stories.
Oh, it really does.
Which brings us to Thursday, April 9th. The New York Times published a massive investigative report claiming that a 55-year-old British cryptographer named Adam Back is actually Satoshi Nakamoto, the anonymous creator of Bitcoin.
A claim that Adam Back immediately and firmly denied.
Right.
Now, the journalist, John Carreyrou, did some incredible digging. He pointed out stylistic similarities in early cypherpunk mailing list emails and heavily emphasized Back's early work on a system called Hashcash, which was a direct precursor to Bitcoin's proof-of-work mining system.
But John Carreyrou is a serious investigative journalist. I mean, he's the one who exposed Theranos. Do we just dismiss this?
You don't dismiss the reporting, but you have to apply critical thinking to the context of that era. The cryptographic community in the late 90s and early 2000s was incredibly small.
Just a handful of people, really.
Exactly. Shared ideas, shared coding structures, and even shared writing styles were incredibly common because these people were all iterating on each other's work.
The real question for you as a listener is, do we even want to know who Satoshi is?
No, I don't think we do.
Right. The ultimate irony of Bitcoin is that the most valuable digital network in human history only works because at its center is a ghost.
Oh.
The moment you put a face to Satoshi, you introduce human liability. You give governments someone to subpoena, someone to arrest, or someone to coerce.
That is exactly right. The enduring mystery of Satoshi is a structural feature, not a bug. It is the core pillar protecting Bitcoin's narrative as a truly decentralized, neutral asset. Unmasking the creator would not only cause massive short-term market volatility, it would threaten the underlying value proposition.
Which brings us to the climax of the week, Friday, April 10th, where the narrative of digital gold clashed violently with real-world macroeconomics. Morgan Stanley officially launched its spot Bitcoin ETF, ticker MSBT.
A massive milestone.
Yeah, and they came out swinging with an industry-low 0.14% fee. On day one, they saw $34 million in trading volume and $30.6 million in net inflows.
Huge numbers.
So what does this all mean? They have 16,000 financial advisors and $9.3 trillion in assets under management. The market must be going parabolic, right?
Well, you would think so,
Yeah.
but you really have to look at the macro reality because despite the successful Morgan Stanley launch, the total U.S. spot Bitcoin ETFs actually saw $94 million in net outflows on that very same day.
Wait, why? If the infrastructure is perfectly built, the legal clarity is there, and the biggest banks in the world are selling it to their clients, why are people pulling money out?
Because an ETF wrapper doesn't protect you from underlying asset volatility driven by global fear. Crypto does not exist in a vacuum. Those outflows were driven by incredibly fragile geopolitical sentiment in the Middle East.
Ah, right.
We saw conflicting reports of a potential Iran-U.S. ceasefire, combined with wild rumors that Iran was charging $2 million per ship payable exclusively in Bitcoin, which is roughly 27.7 BTC just to cross the Strait of Hormuz.
That is wild.
It is wild, but it highlights a crucial lesson. When you have major, unpredictable macroeconomic and geopolitical stressors, institutions don't care about the long-term tech narrative.
They just want safety.
Exactly. They take profits, they de-risk, they pull capital out of volatile assets to protect their balance sheets.
It's a harsh reality check. Okay, let's synthesize this entire week for the listener. If you're trying to separate the signal from the noise based on everything we pulled from Nifty Noon today, here's what truly mattered. TradFi isn't just a tourist anymore. They are moving in.
They are building the roads.
Right. Between SoFi's Solana integration, Franklin Templeton using tokens for corporate buyouts, and CME Group adapting to 247 trading, the physical bridge between Wall Street and blockchain is officially built. Furthermore, prediction markets are solidifying as a legitimate asset class, and decentralized platforms are hardening their defenses against both state regulators and state-sponsored hackers.
That is the core signal. And as for the noise, the New York Times Satoshi Nakamoto hunt is fascinating lore, but it doesn't change a single underlying mechanic of the market.
Not at all.
Looking ahead, what you actually need to watch is how the Genius Act stablecoin rules dictate enterprise adoption, and whether these new institutional ETF flows can withstand the heavy pressure of global geopolitical stress.
That is the perfect wrap-up. Thank you so much for joining us on this deep dive. If you want to keep up with these massive shifts as they happen, be sure to follow Nifty Noon on X and subscribe to our newsletter on Substack for your daily crypto and tech updates. We'll leave you with one final thought to mull over. With traditional finance titans like Franklin Templeton paying for corporate acquisitions and digital tokens, how long is it until the very banks that spent a decade fighting digital assets end up running their entire backend on Ethereum or Solana?